Phil, I hear you use the word generally speaking a lot. Why can't you be a little bit more specific? Like, why is it so general?
Well, because there's lots of different investors out there that we deal with, and so I can't really just say your maximum debt to income ratio has to be X, because that's not necessarily true with another investor that we're dealing with that might be X plus 7. So that's why I'm keeping it general, because different lenders have different guidelines.
So it's because you work with multiple banks, multiple lenders.
Correct.
And they have their own guidelines. And you're really trying to fit the best lender, the best product for the borrower.
Exactly.
Like.
It's all about fit, because somebody who has a, let's say, lower credit score may not fit with the lender that's got the best rates, but we can get them a loan somehow.
Got it. And also vice versa, like you have a self-employed individual, that particular borrower might not be the same type of, might not be the same bank you would send to for, say, an engineer from Google.
Correct.
Because
different lenders look at self-employed borrowers with different underwriting guidelines. Some love them, some scrutinize them very, very difficultly.
Got it. Okay, awesome. What are some of the things that people that are thinking of buying should avoid doing?
Yeah, those are called the gotchas. Well, number one, don't apply for additional credit while you're in the process of either getting pre-approved or actually in escrow to buy a home. Just because a lender's run a credit report, it doesn't stop there. They have a monitoring service that informs us as a lender if new credit has been applied for. So that could ruin your approval.
So when you say credit, you're talking about like credit card, like a new credit card?
Anything, credit card, car loan, student loan, because all that has to be factored into the debt to income ratio.
Got it, okay.
Yeah. So just because we got your credit report doesn't mean it's ended. We monitor all the way through funding.
Got it, and just don't take on like any new debt as well.
Correct.
Got it.
Yeah.
Okay.
Another thing, before you change jobs during the process, talk to your lender about what your salary is and how you're getting paid. It may seem on the surface that you're making more money, and you may be making more money at the new job, but that all that income may not qualify. So, especially around here, because a lot of people get restricted stock units, and it looks like you're going to be making a lot more money at one of the tech firms here. But if you haven't received the stock units, we can't count it, and you may have traded that for a lower salary. So that could mess things up.
That makes sense. So
yeah.
How can a borrower or potential buyer check their credit before they go out and apply with a loan? How do they check their credit without getting dinged with an inquiry?
Great question. I got a great answer for that. You can go to a website called annualcreditreport.com, annualcreditreport.com, and you can get, there's 3 different credit repositories: Equifax, Experian, and TransUnion, and you're allowed to get a free report once a year from each bureau. And so a good strategy is to, if you like to check your credit, is put it on your calendar to check each one every 4 months, like maybe Experian every February, Equifax every June, and then TransUnion maybe every October. And then you get to check your credit 3 times a year for free.
So it's for free, and also you don't get
there's no ding on your, there's no inquiry recorded
it.
on your credit.
That's pretty cool.
Yeah.
Wow.
You don't get your credit score, but you do get to check your credit and see if there's any
Open accounts,
late payments.
late payments.
Yeah, you can buy the credit score, but it does give you a credit report.
Got it. Okay. Hey Phil, explain to the audience what are points?
Okay, points are a fee that you pay at closing that buys down your interest rate. So when a lender quotes you a rate, they have a matrix of rates and points. And this is again generally speaking, for each 1/8 of a percent lower in rate, you're going to pay a 1/2 point. So to get a 0.5% lower than a no point loan, you're going to probably pay somewhere around 2 points. And each point is 1% of the loan amount that you have to pay at closing. So there are benefits to paying those points because you get a lower interest rate. And usually a little easy math equation is you figure out how much you're saving on your monthly payment by paying those points and dividing it by that cost, and then figuring out what your payback period is. So let's say you're paying $10,000 in points and you're saving $500 a month. So it's going to take you 20 months to recover that $10,000 by that $500 savings. So if you think you're going to be in the home for 20 months, it might not be a bad idea to pay those points.
Yeah, it makes sense. Okay.
Yeah.
Nice. Hey Phil, can you just share a little bit about what the difference between working with a lender, an internet lender that's, say, a call center that's based out in the Midwest, versus working with a lender like you that's local?
Well, I think the big benefit of working with somebody local is that on the other side of the transaction, the sellers and the listing agent, they're gonna have more confidence with a buyer that's working with a local lender, because they know that the local lender has a reputation to protect and will really want to do a good job and cares about getting that transaction done quickly and without a lot of headaches. Whereas if you're working with a call center from out of the area, they have no vested interest in creating a reputation with the local real estate community. I need that. I do.
That's true. And a friend of mine actually brought it up that working with you that's local, I have the choke factor.
Exactly.
I can walk on over and choke you if
hopefully it doesn't happen.
If our file just hangs.
Right. Yeah. Yeah. You can come. That's the thing is you can come and talk to me, and we can work together to maybe come up with a solution if there's a snag in the transaction. Whereas if you're working with a lender out of the Midwest or maybe even out of the country, you as a real estate agent can't do that.
Makes sense.
Yeah.
Got it. Okay. Thank you, Phil.
Sure.
So Phil, if I have a potential buyer that comes to me and he just recently graduated from college, can he get a loan?
Well, first of all, they got to be working. So recent college graduates are okay, but generally speaking, a lender's going to want to see them on the job for at least 6 months before they'll be able to approve them for a mortgage.
Wow, 6 months.
Yeah.
Okay, great.
Yeah.
Thank you.